Welcome back. David Heurtel in for Elias. Hope you're enjoying your morning with us on CJAD 800. Well, the inflation numbers are slowly coming down, but we're clearly not finished with rising prices. So for the past 3 years now, the cost of living has continued to rise, from groceries to gasoline and housing, and everything is costing us more. And experts say they don't see any relief coming our way soon. Sebastien Mc Mahon is the chief strategist for IA Global Asset Management, and he joins us now. Sebastien, thank you for joining us.
Hey, good morning.
Good morning. So, tell me, what currently is the situation? Because we've seen some encouraging numbers in terms of inflation slowing down, haven't we?
Yeah, sure. The economy is holding strong, so that's the good news. Inflation is slowing down on an annual basis, which is good news. The danger now is to want to see inflation fall too quickly and maybe do the wrong thing at the Bank of Canada. So inflation, when you raise rates, and at the central bank, this is to bring inflation down, but it does take between 18 and 24 months for any rate hike to have a full impact. So we started last March 2022, to see rates rising. We see inflation falling, maybe not as quickly as one would expect, but this is par with the course, and we need some patience here.
So currently, what is fueling inflation? Because there's still inflation. I mean, I go grocery shopping. Prices are still high, and that's just not. It's not just with food. So there's still very high food inflation. Fuel is still high. I mean, there's still a lot of inflation among us, right?
Yeah, and if you look at pretty much all categories are still showing some inflation on a monthly basis. So compared to, if you look at March versus April of 2023, you see pretty much all groups are going up. But if you have to pinpoint a few things, well, grocery store, of course, it's about 8 to 9% inflation annually that we're still seeing here. So prices are still growing. They will stay high, but they continue to rise. And also shelter inflation. So the fact that we have to pay more for more mortgages now, that filters through the numbers with stronger rent inflation.
So what is keeping inflation going at this point? I mean, why are prices still high? Why isn't it coming down faster?
Well, the main thing here is wage growth, and so wages are playing catch up with inflation. But when we have wages that are growing at a certain pace, well, you have businesses noticing, you have households noticing, and you have some new work contracts that are being signed with a stronger wage growth that is embedded in them. So you get some kind of a spiral going on. And because wages grew strongly last year, well, the minimum wage in Quebec, in Ontario, in multiple provinces was up by 5, 6, 7%. So this filters through the price of services, so restaurants, hotels, and all of that. So we still have this, let's say, this snowball effect that's at work here. And the cure for that is just for the economy to slow down just enough to rebalance everything. This is what central banks, what the Bank of Canada trying to do. It will work, but likely we will see inflation being sticky for the rest of 2023, and maybe we'll have tamed the beast in 2024.
Okay, so I'm just trying to understand. You're talking about the spiral, and I get it. I mean, wages are catching up, and there's on top of that, we're still in a labor shortage situation. So I guess that also puts a pressure on wages.
Yes.
So what you're just saying slowing down the economy will stop this spiral? Because I don't see how that spiral stops or slows down, because it seems that the central banks are very reticent in actually raising the interest rates anymore.
Well, now we have to wait until the impact of the accumulated hikes of the last year make their effect. So we went from about 0% rate to about 4.5. That was one of the fastest and strongest pace of hikes in the history of this country. Same thing in the U.S. So we've seen all of that. Now, I mean, the sequence is that at first, lines of credit are more expensive. If you have a mortgage that is at a variable rate, well, that slows down your spending. But, it's not everyone that had that moment. The majority of people have fixed rates, and when you sign for a mortgage, it takes 5 years before you renew. So it's 1/5 of the population that has renewed. So it's taking its toll month by month, year by year. And if you have slowing consumption, then businesses at some point, they're less willing and able to invest. They're less willing and able to create jobs. So the economy slows down. And at some point, well, you just have this rebalancing that goes from an economy that's overheating to one that's just growing right to eventually one that will be cooling off. And this is exactly what we need to wait for. So likely it's not a 2023 story, it's more a 2024 story. But the variable that's at the middle of that is wage growth. And that's why we think that this year, likely it's too ambitious to expect wages to slow down enough for inflation to get back to 2% and say the coast is clear. But maybe in 2024, we'll get there.
So... But that is very interesting, a very interesting point you're making. So we actually have to wait for the full measure of the impacts of the last year's rate hikes to have its full effect on the entire economy, which is true. A lot of people didn't renew their mortgages last year. They're renewing them now or this year. And so that will have a significant impact on their expenses. So you feel that the central banks should not raise rates anymore?
Well, they need to take a pause here and assess the impact of what they've done. Last year in July, we had the 100 basis points rate hike. Usually it's 25, so it was 4 in July of 2022. So this massive hike likely has not even yet started to bite into economic activity. It does take a while. It's really the snowball effect that you see in the economy, that at some point, a marginal impact becomes bigger and impacts other things, and then the whole thing accelerates or decelerates. So we need to wait for, I would say that likely by the end of this year or early 2024, it will be very apparent that we're in a slower economy, that the impact is stronger. But right now, let's say we're still in the decelerating phase.
We've been hearing a lot over the last few weeks and more now about what's going on in the U.S. with the possible debt default, and it seems to be affecting the markets. Are you concerned about that impacting the Canadian economy?
Yes, we are concerned. I always like to quote Winston Churchill that said you can always trust the Americans to do the right thing, but after they've tried everything else. So they're in this part of trying everything else. Now it's politics, it's negotiating, it's all of that. Likely they will avoid a default. If you have real fears of the default, that means that interest rates will move higher around the globe. That means that you could have some volatility in the stock market. And of course, that will affect our markets too. So, it's always the state of the credit cycle that we call how easy it is to borrow and to lend money. So if the global markets freeze, we will feel that freeze here. They'll feel it in Europe. They'll feel it in Asia. But I think we need to be patient again here, optimistic that they will find a solution. But, I'm not a political expert, but all of the experts that I read, they always say that this is one of the worst political setup that they've seen for something like that to happen. So I would say fingers crossed, but let's not take this lightly. There could be some real economic impact if they go into a default.
Let's keep our fingers crossed. Very insightful. Appreciate your time today, Sebastien.
Great pleasure.
Sebastien Mc Mahon is the chief strategist for IA Global Asset Management.